What's up, guys? How we doing today? We're gonna continue on to the log normal distribution. Let's wait for some people just to be ready and all that good stuff. Let me know if my sounds all right, or my voice sounds all right, or whatever. And we'll get going here in a second. Oh, no. Cool. Thanks a lot, Daniel. All right. Let me just check out the Discord for a minute. Yeah, of course, Daniel. Yeah, I mean, it helps us all out. It really does. Don't think that I want to be streaming that right there. Cool. All right. And all right, yeah, let's get going. We'll let the late people catch up with the timestamps. All right, let's go.
So, characteristics of the long normal distribution and kind of why it's important for us as tasty traders, or anyone interested in finance for that matter. Well, it's a continuous probability distribution of independent random variables. It's not discrete. Now, you have different distributions and different populations that are either continuous or discrete. Do you know the difference, Tom?
No.
Okay. The difference is actually quite simple. If something is continuous, that means it never ends. There's no clear start and stop. If something is discrete, it has like finite countable intervals that are broken up. So a great example would be like if you're walking on the sidewalk, that path is continuous. Mm-hmm. If you're jumping from stepping stone to stepping stone, that path is discrete.
Got it.
Okay, now that characteristic or that set of characteristics in the first bullet point is not necessarily unique to a log normal distribution. Most distributions in the world of finance, at least, are continuous because the stock market is always changing. Is basically what we're saying, right? Well, log normal distributions, and this is where things start to get really interesting. They apply to variables that can only take positive values, i.e. stock prices.
Yeah, sure. Can't go under zero.
Can't go under zero, right? Because what would a negative stock price mean?
Stock was bankrupt or was in 2 times leverage. Well, the funny thing is that when you think about it, though, you would think that it would have also applied to bonds, but it didn't.
Right, exactly.
But it can't apply to stocks.
It can't, right? Because think about it. I mean, if you think about like the logistical, like mechanical outcome there, it would be.
But if you think about how crazy that is in bonds, it doesn't even make sense either.
No, I know. It's wild, man. Like if we looked at McDonald's and it was -20, that would mean here's a share of McDonald's and here's $20. That doesn't make any sense.
No, that makes no sense.
Right.
But it's still, how can you, when you break down, you think about negative interest rates. How crazy is that?
Yeah, no, that's crazy.
Yeah,
That's
how
crazy.
nuts.
You're right.
I don't think people were forced to do
Right.
it, but I think, for whatever reason, central bankers were forced to do it. I mean, who would not take money if you were paid to take money?
That's crazy. Here, let me give you all my money, right? And
Pay you to take it.
and I'm gonna pay you to take it. I don't want anything for you to give me that service.
It didn't stay that way for a day. It was almost a year. Yeah.
Not here though. It never got. It was Switzerland and
Germany.
a couple other places. Yeah.
But it's crazy. Anyway, so all the reason I said is because you said positive values only.
Yeah.
Right, but
No, it's not. There are a couple areas areas where things should be log normally distributed.
Sure.
Interest rates usually being one of them.
Yeah.
Although that one can spill over a little bit. Well, what's interesting is if X is log normally distributed, then the log normal distribution of X is normally distributed. Now that's kind of a mouthful, but that has very important implications for us.
So basically, what's kind of going on here is this is a tasty option skinny on abstract applications, or skinny on options abstract applications, and they're discussing kind of the log normal distribution, and the log normal distribution meaning that stock prices can go to infinity and they're bound by zero. And that last point right there, that if you take the log of the log normal distribution, then you actually have a normal distribution, and that's a little bit more theoretical, but it actually does play out, and that's a lot of the tools that the BApig uses. Essentially all of them, they're based on returns, and returns is essentially what he's referring to. So you have stock prices, which are random, and that's the essence of the log normal distribution. And then you have returns, which aren't as random, and they follow closer to a normal distribution, or the normal distribution characterizes returns fairly accurately, and that's a big point, is that these distributions and the assumptions that we're making, this is to characterize stock prices and returns. Returns and stock prices do not characterize the distribution as much, obviously, because they are their own entity. So it's kind of the way that we're looking at things is that we're putting this lens on, and the statistical lens, and this is kind of helping us make decisions. But thinking about stock prices and things like that, it's big to be able to understand that they're a random walk, and this random walk, we put a log normal distribution. We look at it with a log normal distribution, and that's what we'll be looking at, and just kind of looking at things. Well, it's intuitive in nature of being bound at zero, and they can go to infinity. That's stock prices, and then if you take the log of those stock prices, then you get into returns. And those are your plus or minus returns, and plus or minus returns essentially follow closer to a normal distribution, which is essentially positive infinity to negative infinity. While you can't have negative price, you can obviously have negative returns. But just kind of looking more at that, and seeing how we can kind of educate ourselves, and for instance, the way that we could put this into practice. If you're naked selling calls, just know that stock prices can go to infinity. So you might think about buying that insurance, buying that call, just to make it a spread, instead of just kind of being at a mercy to the randomness that is price.
Today, and that last bullet point is really the main takeaway that we're going to work on here in the next 8-9 minutes.
Okay. Next
Yes.
slide? Perfect.
So if we look at this kind of visually, right, like how do they stack up, right? If you think about a normal distribution and a log normal distribution, what do they look like? Well, you've got, your normal distribution, kind of that aqua color, which is your classic bell curve.
Sure.
Now, in this graph, I wanted to go ahead and give it the possibility of having positive or negative values. So we see kind of zero being the peak of the mean, the median, whatever, right? But it may or may not be positive, negative, right, with normal distributions. Like if you're talking about returns, they can be positive, they can be negative.
Yeah.
But like for me, like in the classroom, when I used to grade exams and stuff, I saw bell curves in that environment too. But in that environment, that was more of a log normal distribution, sort of, in that it only took positive values. But the results were always normally distributed. It was pretty fascinating. actually. You see this stuff just play out all the time. Log normal distribution, just visually, it's going to be truncated, kind of concentrated in only that positive region.
And that's because, so people, when they're thinking about this, can just think about it in terms of, your downside is limited to 0 and your upside is infinite, theoretically.
That's right.
Okay.
That's exactly right. Now I want to stop right here for a minute because I think this is a really important discussion, what we're going to talk about for the next few minutes and what we've talked about thus far. Because I think a lot of people, when they learn a little bit about distributions and a little bit about the stock market, they get just enough information to where they can be a little dangerous. But they don't have enough information to where they see the big picture and kind of have, all the details. And this is a good example. Because people might hear, all right, well, you guys put all your stock in the normal distribution. You guys put, you center your whole trading philosophy around the fact that things are normally distributed. But stock prices aren't normally distributed. So people look at that and they're like, hey, man, there's a disconnect. Like, what's going on, right? And that's why I wanted to do this segment here today, because it's very much related to central limit theorem, law of large numbers, all that kind of stuff. But this really is just another piece of kind of connective tissue in the whole thing.
Well, the reason that we talk about normal distribution, I mean, to us, it really, whether you call it log normal or normal, it doesn't matter, because to us, remember that, like, 97% of what we do takes place in the space that's in between. So it doesn't matter what curve you're looking at. 97% takes place inside of that curve. What you're talking about here is, the stuff that you can't really put context around, or the tails. I mean, is that fair?
I sort of agree.
Okay.
I don't necessarily, I don't disagree.
I'm not trying to...
Because you're my boss, and I have to be very careful about what I disagree with.
Do you feel that way? Honestly,
See, like that part right there, where Tom kind of puts his 2 cents in. That's not. We're looking at stock prices, the pink line, and we're looking at stock returns, which is the blue line or the blue curve. And thinking about that, that we're looking at these things, but obviously returns, they don't have to be perfectly normally distributed, and you can see a lot of different assets that are not perfectly normally distributed, but it's a good way to look at things and just kind of think about that as we're moving along, but like so to have indicators based off of price that can go to infinity, that doesn't make really too much sense. But having indicators based off of returns, that's where it's at, and that's what BApig is all about, and they've really kind of hammered that point home, and that's what I'm trying to do.
I don't think he feels that way for 1 second.
No, I absolutely don't. No.
If he had a chance to say I was dead wrong, he would love the opportunity.
Hey, man, I learned tact at an early age, right? And so, if you just look at the curves, right?
Yeah.
Like, think about plus or minus 1 standard deviation. Everything we do is within this range.
Of course.
That works out perfectly with a normal. You try to do that with a log normal, it's not going to be. It's not going to have the same.
But the reason that we don't, what I said was, no, I understand it. What I said is, the reason we don't talk about it is because we don't talk about things, like if you have a stock trading for 100, right? We don't talk about that stock going to 0. And we don't talk about that stock going to 1,000. It's $100.
Agreed.
We don't talk about it going to 0. We don't talk about it going to 1,000. What we talk about is, what if the stock goes from 100 to 110? So it doesn't matter what kind of, curve you're in. That's all I'm saying. Because in our little world, it all falls in the same space.
I agree with you there, in that so much of what we do is just on either side of
That's
that.
right.
Yeah,
That's
no,
right.
I agree with you there. But here's what's great, Tom. Regardless of our disagreement on this slide, on the next slide, we're going to see.
See, like right there, Tom, like he's talking more about theoretical, that we only trade on the inside of the curve, and thinking about that, well, that's actually wrong. When you're naked, when you're selling naked positions, that or if you're short futures or whatever, that you actually are taking into account that, you should be taking into account that risk from my perspective, and that when you enter into a trade, yeah, you want it to fall within that 70% range, and you don't want to be looking for the tails, but you should always know that there is that tail risk of going to zero or to infinity.
Everybody can win. Tom, I'm all about win-win situations.
I don't have any disagreement at all. Go ahead.
So here's the meat and potatoes, or in honor of pecan lives, maybe the brisket and the collards. So here we go, right? So the Black-Scholes model. The Black-Scholes model, which is kind of, that's kind of the centerpiece that we base so much of what we want to do around. It assumes two things. It assumes that prices are log normally distributed, which makes sense. It also assumes that our returns, which is what we really care about, are normally distributed.
Sure.
So I want to stop right there because that right there is going to kind of build this bridge between a log normally distributed stock price and a normally distributed return. And when I saw this and learned this many years ago and understood this, that really kind of illuminated the room for me and made me realize, okay, it's not one or the other. They're not mutually exclusive. It's not a situation where because stock prices are normally distributed, the normal distribution doesn't matter. Because in reality, with something like the Black-Scholes model, they coexist, and they're both underlying assumptions of the model.
Good.
Central limit theorem, we've already seen this, but I want to bring it up again just briefly to get you ready for your quiz. The sample distribution will always be normal. No matter what the population's distribution is, in this case, it's log normal with prices. If you pull out 45-day samples like we do, that sampling distribution is going to be normal. It doesn't matter if the underlying distribution is log normal, if it's chi-squared, if it's Poisson, if it's...
That's kind of what I was just saying. Kind of.
Yeah, in a not really kind of way. In the most not really kind of way.
You're calling me unsophisticated.
I'm going to let I'm just going to let the quiz results speak for themselves. You're going to have an opportunity. You're going to have an opportunity to show your skills. With stocks, though, this is what I also think is kind of interesting. And this kind of goes off a little bit from the core of today's discussion, but I thought it was interesting nevertheless. And, I didn't have to pitch you on Friday, so I thought, we'll run with it. With stocks, we prefer log returns over simple returns. So when you think about stock prices being log normally distributed, and you think about your returns, which is what you're really after, that's what we're talking about in those first few bullet points. But another thing that's kind of interesting, and it's going to sort of lead into what I think I want to do next Monday, is this preference for log returns over simple returns. And here's what I mean. Let's say you start with $100. Just that's your account, right? This could be anything. In the first period, you build it up to 110. In the second period, you build it up to 132. If you take your simple returns of those two periods, you earned 10% the first period and 20% the second period.
Okay.
But at the end, you have $132. So now, it looks like you earned 30%. 10 plus 20 is 30. But at the end, you actually earned 32. Right?
Yeah.
You start with 100, you have 132. So there's an inconsistency there.
Okay.
There's a mathematical, it's not computationally consistent. But if you actually take the log of the returns for both periods, it works out perfectly. We would call this time consistent in the world of mathematical returns. Your logs for the both returns are 953 and 1823 respectively, which is 2776 or 2776, no matter how you look at it with what you have at the end.
Very interesting.
And so it's just an interesting little thing that,
That's kind of cool.
yeah, since, tasty trivia, HQ, whatever it is, it's, it's fun. So.
That's good.
Yeah. So hearing that stock prices are log normally distributed might appear to render the normal distribution obsolete. But that's not true. We keep seeing that over and over again. Central limit theorem, law of large numbers. Now we see it again with the...
So kind of thinking about that is that we might be drawn to the fact that saying, oh, let's throw the normal distribution out the window. We've got the log normal distribution, but there is still, like, these are just ways of looking at these markets or prices and returns. These are ways of looking at prices and returns, and they're more so tools and less so laws. But they are rooted in mathematics and are much more widely observed throughout different securities and whatever you might be trading. But yeah, so don't throw out the normal distribution when you're looking at returns.
The log normal distribution, which was a hang-up that I personally had in trying to figure out where the normal distribution made sense, and then I realized that they can coexist. But our preference for log returns and the central limit theorem restored validity. Thus, Tom, man, the normal distribution continues to serve us well. I don't know what else I can tell you, man. You know, I think we've beaten this horse enough. We may actually
Too many questions.
talk about something else.
I think Jim makes normal and log normal distribution more interesting than anybody else in the world.
Hey, man, I gotta get people ready for the geeks in 2 weeks. Because
I got the stepping stones in my head. Now I got it.
Yeah.
I mean, seriously, it's a great example.
Oh, thanks, man. Yeah, no, I mean, I'm obviously fired up for 2 weeks, but I understand that the evolution of a distribution, seeing that the title of a talk doesn't exactly get your juices flowing, and so just trying to get people.
Well, I think the first time I sat through a statistics class.
Alright, yeah, so that's kind of like the gist of that video. You can always go in and you can view the slides, and that will definitely, you can refer back to that, thinking about things like continuous versus discrete, and I mean, prices being continuous so they can go in terms of infinite to the upside, and then obviously I'm having discrete variables. Such as your HVP, you know, that's bound by 0 or 100. So yeah, so we can. Sorry about kind of having some technical difficulties with that. I'm gonna get definitely a better my full desktop computer so I can. Yeah, for sure, Daniel. They really are. They've really helped me. Dr. Jim, he's the man. He definitely helps out a lot with these types of things. Alright, so let's go into this one. Not that one. As far as explaining the indies, I don't know if those are even active anymore. I know in the Discord there's some of those videos floating around, but I'll see what I can do to compile them. But I mean, there's been so much advancement and innovation with the tools that I mean they're going to be coming out with a lot more in-depth videos, and that's kind of what I'm here for as well. So, but yeah, but thanks a lot, guys. So let's go in. Yeah, let's see if this is on here yet. Yeah, seems like they are. Cool. All right, and let's go. Or not that.
And you know, if you're a tasty trader, it doesn't take long to be met with our content to realize that everything we do is based on the normal distribution. And so Beth Q's up here on this first slide. It did take me about 30 minutes to spell ubiquitous correctly, by the way.
I was going to say, ubiquitous would be a tough one for me in the spelling bee, but I think there was a girl I went to high school with named Ubiquitous.
There you go, man. I'll tell you what, if it wasn't for those quickly lines in Microsoft Office, I never would have gotten it. Never would have gotten it. Okay, so here's why we do what we do. It doesn't take much time on the Tasty Trade Network to realize that everything we do is rooted in statistics and probabilities. I literally just said that. Specifically, we place a heavy emphasis on the normal distribution with its mean, standard deviation, skew, etc. The reason why we do this is that regardless of the underlying distribution, things ultimately become pretty normal. Now this is kind of fascinating, right? So if I know everybody is doing crazy stuff this morning and there's lots to do, but if you guys could lock in for 5, 6, 7 minutes, everyone watching out there, I think this is really going to provide potentially the most convincing argument for the normal distribution that you will find anywhere on the internet.
All right.
Ready? Okay, all right, Beth. So cue us up here on this first graph. So the first distribution that I want to talk about this morning is the binomial distribution. Now, if you look at a binomial distribution, this is kind of your classic on-off situation, where you have some probability of some event occurring, and it either happens or it doesn't happen. Right? It's on-off. It's up-down. It's left-right. It could be a 50-50 proposition, like a coin toss, for example. But it doesn't have to be a 50-50 proposition. It could be some proposition with a probability of 80%. Like it could be a free throw shot, or it could be a probability with 16%, like the roll of a die. Right? It's just an on-off scenario. It either makes it or it doesn't. Well, two interesting things. The first thing is this. If you have enough, the distribution, and you can kind of see it there on the graph, that sort of looks kind of normal, right? Just the way it naturally sort of populates, it already kind of has this feeling of a normal distribution. As long as you feed it enough trials, it's going to be normal. It's going to be bell-shaped around the probability that you might expect. So to jump from a binomial distribution to a normal distribution is actually not that big of a leap. Now, naturally, some people might be asking, all right, Jim, that's sort of interesting, but I'm curious why there's so many distributions to choose from. Why did you choose the binomial distribution? What relevance does that have to what we're doing every single day? Well, interestingly, it doesn't have the relevance that it had 70 years ago. So 70 years ago, or 60 years ago, I don't know the exact date, but the precursor to the Black-Scholes model was the binomial option pricing model. Which is so, and I had to learn all about this, going through grad school and before they let me out with my doctorate. Like we had to study all of this and all the history and the evolutions of the distributions and all that stuff. What's interesting, super fascinating, is the binomial.
Yeah, and the Black-Scholes model is the most widely used option pricing model that people, that really everybody uses, and you'll kind of see why, as opposed to what it was before, which was the binomial pricing model.
Option pricing model, it was like a decision tree, right? Where you would just kind of plot it out. You could do it by hand, but we didn't do it by hand. You plot it out, and it's okay, the stock price goes up, the option price will be X. The stock price goes down, the option price will be Y. Whatever the case may be. And then you kind of start with the end in mind, and then you back up to what the option price should be. You would think that something so rudimentary, that something so elementary would not be able to price options that well. The reality is, it actually did a pretty good job. Now, don't get me wrong, the Black-Scholes model in the continuous world that we live in, much, much better, much more efficient. But man, for just starting with a basic up-down scenario, the binomial option pricing model did a very good job. Okay? All right, so let's keep the binomial option pricing model and a binomial distribution kind of in the back of our minds, okay?
For sure.
Okay, next slide. All right, guys. So the next distribution, this doesn't look normal at all. This looks very abnormal, as a matter of fact, right? So this could be, some value over time, right? And this is where you start to bring in some convex functions, some concave functions. This could be gamma. This could be theta. This could even be.
Yeah. A normal distribution is just a bell curve distribution. Think back to that last video, that blue line versus the pink line. So you'll see it coming up here.
I don't know. This could be your risk aversion over time. Risk aversion doesn't look like this, but risk aversion does have kind of a concavity to it over time. When I look at this distribution, right, it doesn't look normal in the slightest, right? It's okay, a binomial distribution, all right, Jim, that's sort of normal, kind of. This is not normal at all. This would be a geometric distribution. Like when you have a concave function or a convex function, you usually run into something that's more geometric, something that's more exponential in nature, and this is just another style of distribution, another type of distribution that, of course, has relevance to us, with things like gamma and theta. And we're not normally plotting gamma and theta over time like we might with prices. Of course, we do to control our risk, but we don't do as often as we might something else. So this distribution appears to have no relationship to the normal distribution whatsoever. Okay, so Exhibit 1, binomial distribution, it's kind of there. Exhibit 2, geometric distribution, it's not there at all. So Beth, cue us up on Exhibit 3 here, this next slide. So the next one, and this one might be the most relevant of the three, the log normal distribution.
Yeah, so this is the log normal, of course, like Jim said, and then you can see how there is that hump which represents the majority of prices, and then you can see how there's the tail, and think about how that could lead infinitely. And then you obviously have the bounding at zero, because obviously stock prices can't go below zero. I hate to be redundant, but I just want to really drive home the point so that you can kind of not only get the mathematical explanation, but you can also get the intuitive understanding, which is why I like finance a lot, because there's a mathematical explanation, and then there's also an intuitive explanation. So that's a big draw to this, and so you can kind of see how the majority of stock prices are there, and then there's that long tail that ultimately leads to infinity.
The log normal distribution is going to look something like that. Now it sort of depends on where the skew might be. I mean, this is obviously a positively skewed log normal distribution. People find Tasty Trade, and they get, introduced to the world of options, and they're like, wow, there's so much opportunity here, there's so many more things I can do, the flexibility, the liquidity, like, it's unbelievable. But one of the kind of, let's call it obstacles, one of the obstacles that new traders almost always face, and I get these emails all the time, is, Jim, wait a second, have you guys kind of missed the mark a little bit? Because you guys use the normal distribution so much, but stock prices aren't normally distributed. They're log normally distributed. So how does that, where's the connection here? Like, have you guys missed the mark? You guys have done, 8-9 years of research and content. Like, did you guys kind of have a little typo there in the beginning? Like, this should be log normally distributed. Well, a couple of things to that note. Number one, stock prices are absolutely log normally distributed. When you have something that's log normally distributed, one of the characteristics of that distribution is you can't go below zero. And that makes perfect sense for something like a stock price, because you will never see a stock price fall below zero, because of course zero is the floor, and that would indicate bankruptcy. You no longer have a solvent entity. So a log normal distribution makes a lot more sense. If you actually take the logarithm of stock prices, you will find their returns. Their returns are normally distributed. So there is that connection when you do that little, that little computational shift from looking at the log normal distribution to taking the logarithm of the log normal distribution and arriving at the returns. The returns are normally distributed. But here's where, so now we're going to bring it all together, right? So that was all kind of content.
So thinking about that, so people be like, oh, so why do you spend any time on the charts and with these indicators? And that's the perfect response for it. Is that yeah, stock prices are log normally distributed and they can go to infinity, but there's the returns, and that's what these indicators are all about, are the returns, and those follow closer to a bell-shaped curve from kind of theoretically. So then looking at that, so a lot of these different indicators, then you can start to form assumptions and observe those, and that's where there's some edge in learning this and putting them into practice with a bunch of different tools, primarily from BApig.
We have a binomial distribution. We have a geometric distribution. We have a log normal distribution. Beth, cue us up on this next slide. This is the most important point. It doesn't matter what distribution you have. This applies to the three that we've looked at. This applies to a chi-squared distribution. This applies to a Poisson distribution. I just didn't want to include those this morning because, we'd be talking for 30, 35 minutes. And I figured, about 8-9 minutes of Jay Schultz, that's plenty. So if you take a sample of any of these distributions, any of them, it doesn't matter. Geometric, binomial, log normal, chi-squared, Poisson, fill in the blank. If you take a sample from those distributions, Your results. You don't have to take logarithms. You don't have to change the values. You don't have to do anything. Your results will almost always be normally distributed. And I'm only saying almost always because all the ones I've seen are normally distributed. Maybe there's some crazy one out there that I haven't seen, so I'm going to leave myself that little out. But I'm pretty sure this is universal. I'm pretty sure this is ubiquitous, Tom, just like that young lady that you knew, 45 years ago. And so this is crazy, right? Because, again, this is why we rely on the normal distribution so much. This is why we use mean, standard deviation, variance, right, skew, kurtosis. And it's just all of these things, they all trace back to the normal distribution. And so Beth, cue us up on the next slide, and then of course I want to give you guys a chance to chime in, but I know it's been all business this morning, so we kind of had to button it up. Regardless of the underlying distribution of the random variable in question, the distribution of samples taken from that original distribution will almost always be normal. This is why we continually use metrics like mean and standard deviation to assist with probability analysis, strike selection, long-term expectations, right? Like when you're thinking about your win rate, when you're thinking about your profitability, when you're thinking about your risk tolerance, when you're thinking about your capital at risk, your buying power reduction, everything is going to trace back to the normal distribution.
Sosnoff?
Sorry, I was just typing something up. The S&Ps were getting to a level that
It was up $6.
screwed up from the exchanges this morning. So
Yes. But I'm getting fills.
This is kind of just them talking about the markets and how that relates back to what Jim just kind of
So Tom, what are you more impressed
lectured
with?
about.
Are you more impressed with the surprisability of the market, or are you more impressed with the segment that I just delivered on the Tasty Trade Network?
well, I'm always more impressed with you, Jim. I mean, anybody can create a vaccine, and anybody can send the S&Ps up to any level, but your stuff is you're a different animal, man.
Anybody can create a vaccine, but only I can talk about the normal distribution like this. There it is, right there.
I mean, God put you here to do a certain kind of work.
He sure did, man.
Like pick the day with the craziest markets ever, and then bring Dr. Jim in to
Oh man, this is really crazy.
God's work.
Yeah, oh my gosh, no question about that. He's doing an incredible work in my life, no question. But I'll tell you, this morning too.
Who knew you were sent? Who knew you were sent to this? Who knew you were put on this planet to do the option God's work for him? You could be that realistically when your lock limit.
All right, yeah, that's just kind of them bantering back and forth. There was a good part at the end where he kind of puts that into perspective with what is going on in the market and how there's negative skew in the marketplace and negative skew meaning that there are more amount there's a higher number of down moves, but the significant moves are positive. So the significant moves are increases. The ones that tend to have a lasting effect, and the non-significant moves are decreases in price, and that type of perspective, and it was on November 9th. I guess there was a significant down move. All right, so we just learned more about the log normal distribution, hammering home some of the points. And kind of how they relate back. So just because the log normal distribution fits stock prices much better than the normal distribution doesn't mean that we throw the normal distribution out the window. It's that when we're looking at derivatives of price, they tend to follow a normal distribution a little bit better. So yeah, let's look at some derivatives of price, or some derivatives of returns, and let's go into the tools. Just one moment while the stream kind of catches up here with some of the things here. For some reason, the streaming software doesn't take TradingView as a valid input a lot of the times, so I just have to do things manually, and it really affects the. So let's see if we can do this one more time. So let's see how that looks. Oh, what I need to do is that. Yeah, still having trouble picking up TradingView as a valid input. I don't know why, but we'll get there. Cool. I think this will do it. Hopefully. Yeah, it just has using Streamlabs desktop. I mean, maybe that's the problem. Yeah, real sorry about that, guys. We'll get it going here. Bear with that for 1 minute. All right, cool. We should be good to go. All right, so kind of looking at, all right, so we just learned about how, let's make things a little bit simpler here. I was looking at Ravencoin. It's a good coin to mine. All right, so let's see. We'll go to market drivers list. So I just have a market drivers list. I will definitely post this in the incubator, which is a Discord server or the Discord server to learn with the BApig tools, and you can kind of look at this. So this is a lot of different drivers of different markets. I don't know as much about Ravencoin, but it definitely is people care about that for mining as much. So let me just make sure that I have this going on here. Got a couple of different things going on here, but hold on. Yeah, all right, cool. All the people in Discord, if they want to join or chat or whatever, feel free. All right, so yeah, just waiting for some people to join, whatever. But UVXY up 4%, and let's go. Yeah, let's go to Nasdaq. So kind of taking into account a lot of that stuff right there, about the log normal distribution and all that. Let's continue on here. So we'll turn our expected move off, we'll turn our do off, and yeah, so price being the candlesticks, and this can obviously go to infinity. This is a good instance of that. And so this being log normally distributed, and the ability to go to infinity. And then we can look at returns. So then I can go over here, and these are more so the different ways of viewing the returns of the Nasdaq. So this is the future. So this is a derivative of the index that it's tracking. It's the top 100 companies listed on the Nasdaq exchange, and companies like Amazon, Nvidia, Facebook, Apple, So these are the returns right here. So the returns are going to be closer to a normal distribution as opposed to a log normal distribution. So that's what you want to take into account when you're looking at these things. So it's like, oh, why would I even care about all of this if prices can go to infinity? And it's because these are looking at the returns, which is a facet of price, but looking at it in a different way. So just kind of using that knowledge, so that it helps us kind of be able to get a frame of reference, and things like the self-similarity of returns, and using these standard deviation bands, which will show you, I think it's the second standard deviation. Yeah, the second standard deviation from the mean. So when returns are outside of the bands, it's saying that it's outside of 2 standard deviations from the mean. So it's outside of our 95% range. So looking at that, it's like, okay, it's deviated very far from the mean. And then you can kind of look back historically, and you can say, oh, okay, all right, so self-similarity dropped to an extreme low of point negative 68, point negative 70 or whatever. Yeah, point negative 70, and on this last dump, it's went down to point negative 56, and just because we're putting a normal distribution onto things. Just because we're putting normal distribution onto things doesn't mean that they're bounded by the second standard deviation or the third standard deviation. Those are just ways that we're looking at it, and that they can go to negative infinity to positive infinity. So definitely make that known, is that just because it's outside the bands doesn't mean that it can't go lower. And I mean, we got a great, or actually, yeah, the second standard deviation band right there. But it's just that it's unlikely to go much lower. If it's truly a third standard deviation, that means that there was a 0.15% chance, or 0.15% chance that returns would get there. And so SSR input is put to closing candles. So it's each candle close as the input. You can change that around if you'd like, but you can kind of see how it changes things a little bit. But I wouldn't recommend doing that. I would just kind of recommend using them as they are. And this isn't the self-similarity of price. That wouldn't really make too much sense, because price is a random walk. So this is the self-similarity of return. So these indicators are doing the calculation for you. And this is the visual representation of that calculation. So, and they also have gradient features just to make seeing things a little bit easier. All right. So, so looking at that, it's like, okay, so this is going to be closer to a normal distribution. So I wouldn't really care as much about this, which is price, that can go to infinity or to 0. It can go. So then, like, I mean, all these people that are putting stuff like they're visually looking at price, it doesn't make sense, because that there isn't really a bound on price. So so I mean, it's about 3 o'clock right here. So I mean, what we'll do is we'll kind of just go through a recap of the markets, and throw in some tickers, and we'll definitely get to those at a certain point as I get through the bulk of the markets. All right, so let's check out the NAS. This is on the daily right here, and we can see some things here. Let's see. For some reason, because I'm on the 12-month, that would help. So, a feature of TradingView, once you get the Pro, is that you can have multiple different layouts, and when you have multiple different layouts, then you can you can have different, you can change up in intervals. You can have, so I could even have the Nasdaq in the middle. I could have the S&P on the left, and I could have the Dow Jones or whatever on that pane if I wanted to. But I like to have it for one ticker, and then I like to take the interval off so that I can look at the daily in the middle chart, and I can look at the 4 hour on the right chart, and then I can look at the weekly or whatever on the left chart. And as my chart goes, I'll be sure to let you guys know, is that in the middle, we'll have a monthly expected move. On the left, we'll have a weekly expected move. And then on the right, this will be returns focused. Well, they're all returns indicators, but this will be kind of the characteristics of different returns. I'm looking at whether or not we're in a random walk, looking at whether or not there is trend or autocorrelation here, and also looking at whether volatility is low or high. And you can see how volatility is rather high right here. Sorry about kind of having such a chaotic type of setup, but I'll definitely refine that as I go. But you can kind of see, all right, so this is a much lower length right here, so it's going to be a lot more reactive, and you're going to see contractions and expansions rather quickly. And then over here, this is a higher length, so then you're going to see expansions and contractions that take place over longer periods of time. And yep, then you have your self-similarity of returns. Let me just move this down, so then you can go to the 3 dots, and then you can move to. You don't want existing pane below, because then that will overlay it. You can overlay indicators like the HVP that I did. I think credit to Weebos on that. Dude's always coming up with cool ways to display returns. Let me move to. You can always go to object tree. So then you go to the object tree, and then you can get that over there, but then that will overlay that, and then you move that to new pane below. And I don't really care about price on that chart. I don't really care about price as much, only when I'm executing orders. That would be it, which that's not something that I came up with at all. That was in the Discord. Guys like some dude, Anton, they're always kind of dropping knowledge, and I really like that. Is that yeah, you're looking at returns. You're not. I mean, why would you care about the thing that can go to infinity or zero? Wouldn't you care about the returns that are closer to a normal distribution, right? Because there's different characteristics and stuff like that. But anyway, yeah. So we'll take mutual information off. Let's see here. Just getting set up. And we can, so there's a couple different commands that you can do. Double click to expand the full chart, and then you can do Alt plus click. So that's why, like, if I mean when I'm doing different analysis, I can Alt and then Alt plus click, and then you can see that okay, the craziness is kind of been tamed for a little bit. So let's see. All right, so we got the Nasdaq right here. Crazy move that we had over the past couple weeks here. And yeah, so we're going the expected move. So it's a multi-time frame expected move. So it's really cool. So you can have So I'm looking at monthly expected moves. But I'm displaying daily price, which is nice. And not only daily price, but also daily returns for the other indicators. So that's a way that I like to look at things. But we can also, I can also change that too. So I can go to, all right, same as chart. So whatever chart I'm looking at, it will give you an expected move. And the sample size of 27 is not good. That's not sufficient for a daily. For a monthly, it more so is, because think about 24, you're sampling the past 24 months of closing price data. So that's about 2 years. So then we can go in and we can type in 1,000. So that's your law of large numbers. I mean, 1,000 sample size. That's something that I mean, that's closer to what you want. And I'm pretty sure the max input that you can put in here is 4,999, maybe 5,000. And so think about, I mean, that's a lot of data that you're looking at is 5,000 candles of S&P or Nasdaq closing price data. So yeah, so I mean, even I think 1,000 is sufficient for a sample. And all right, so the dots represent the 1.5 standard deviation, so 12 and 12, or as that would be looking at things on like a normal distribution type of thing. So yeah, you kind of categorize that as close to an 87% probability of price closing within this white area. So the white area being, okay, so there's an 87% chance that price closes within this area. And then you get to the yellow part, and there's 2.5% chance that that price closes there, and then there's a 0.15% chance that price closes there. So that gives me a way to really kind of give some perspective on moves. So like for instance today, there's less than a 12% chance that, or there's a 12% chance that price will close outside of here, or at 12% chance of price closing at 16,150. So you see this Nasdaq, like the Nasdaq very rarely has 3% updates just because of the size of the index. It's a massive index, and it takes a lot to be able to have a 3% move, or $475 in the future. That this was a 2 standard deviation move right here. So there was less than a 2.5% chance that price was going to close at that level, and price did close there. So just because it's there, so price can do, I mean, yeah, price can go to infinity. So think about that. So then you're looking over here, and price closes within the 87% range, and I can also make this 70% too. You know, I could just go 30 and 30, right? Or I could do it as we could view things as that first standard deviation. We could do 32, right? And then this is going to shrink the range right here. So then this candle will be outside of the 32% range, and just giving it some time, because when you add in that 1,000 candle look back, every single calculation is going to obviously take more time. But yeah, so 32% range right here, the middle of the distribution being at 16,440 on the daily, and yeah, so just kind of looking at things on the daily right here. If I were scalping Nasdaq futures, I'd probably look to buy some Nasdaq futures just over the next day or so. But that's not sufficient for an entry or anything like that. You need to have much more criteria than just that. But you need to look at other metrics. But hey, that's a great lens in and of itself. So all right, so let me get this back to a monthly, right? So I'll put this on 24, and then I'll put this on to a month. And yeah, you can see, so what happened there. This is the 1st of December. Usually this line is a little bit thicker. I can see it a little bit better. Maybe if I make it blue. Yeah, okay, that's a little bit better. Yeah, so then the monthly expected move obviously gets updated on the 1st of every month, which is pretty damn cool, based on the previous month's the previous 24 months candle closures. But then you get that new bit of data, which is cool. And then I like to have a bigger range. So then it really solidifies the fact that the move here is improbable, and even having the upside, up here having a different range or a different probability input. So then we're looking at things, and over here, so when you look at the dots and you look at the expected move, when you look at the expected move, think about things on the monthly, and then when you look at the candles, think about things on the daily. So this right here, there is a 2.5% chance that the Nasdaq was going to close at 16,700 for the month of November, and there was that move down in price. I mean, it could close up there, but it's just not likely to close up there. And it works both ways. So then you can look down here and you can say, okay, there was a 12% chance that price was going to close at 12,335 in March of 21. So this past March. And so you can kind of see instances, just know that when price gets up to these areas, to these dots, it's improbable that price will close there on a monthly. Daily, this isn't the odds for a daily. So yeah, exactly. And then you're looking at the VRT, and you're looking at the Hearst, and you're looking at these things, and you're looking at HVP, and I'm saying, how much more can vol expand? And HVP is just one measure of vol. It's similar to options trading, and when you're looking at IV rank, that's just a measure of IV. That's just one measure of IV. That's not like the whole thing. Oh yeah, IV is at 100. Well, that's just you're just comparing it to the highest and the lowest point of the past year, or however many samples you're taking into account. So then looking at this right here. So yeah, we went through a bunch of different Nasdaq companies because everybody loves trading the Nasdaq because it's a tech, right? And they were like Apple, Amazon, like all of them. Well, not all of them, but like the big players. They were all like at a weekly improbable point. So then that's why I like to have a weekly expected move. And this was for the past year, but I like to have even further. So like I like to standardize it as much as I can. So then you have a weekly going back 2 years, roughly 104 candles. If I wanted to, I could, we could obviously add on it's just easier to type 100, but 104, right? So, and then over here, I have 24 months. So we're kind of comparing apples to apples in a sense. But still though, this is a weekly and this is a monthly expected move. So obviously you're going to have much more of a range for a monthly because you're going to have larger returns over a larger period of time. That kind of goes back to the log returns a little bit, but so looking at this right here, then I can go and I can be sure to kind of expand that, and then if I wanted to, then I could go and I could say, okay, I only want to see 2 frames, so I can see 2 frames, and it makes it kind of easier for people who didn't make this setup. So then we can see on the weekly there was an 86% chance and an 88% chance that price was not going to close up at 16,430 on this week's candle. So this week's candle, and then that can kind of help you look at things and say, okay, like I'm having this feeling like when you're not looking at any of this stuff, you have a feeling that you want to buy because you see price moving up and things like that, but there are likely better entries or ways to add on to your position is kind of doing it like that. So you're looking at it and saying, oh yeah, Nasdaq's back to its glory, and it's never really lost its glory. That's going back to the log normal distribution. You have more frequent down moves from what we've observed, and then there's but the significant moves, like the lasting moves, are positive. So then you're looking at that and you're saying, okay, I'm not going to buy at 16,400 on the Nasdaq because likely that's raising my cost basis, like the cost of how much of my entry point or whatever, and then I'll wait for it to get down to this midline, or I won't even enter enter until there's some type of improbable event. So yeah, it's kind of looking at expected moves right there. They give you enough. I mean, that right there is telling enough right there. You can see how the monthly and the weekly come into play, instead of getting lost in the minutia of the 4 hour or whatever. And the 4 hour is great too, because you can kind of see it on a granular level, and you can kind of zoom in. So going back to the microscope analogy. Bali said one time that which he's one of the main he is the main force behind all of this, behind all these indicators, is that when like a big shtick with like TA and all that whatever, is that like when you get all like this access to like TradingView, and you can look at the 5 minute time frame, you can look at the 1 minute time frame, and you're like, which time frame matters? Like, I'm looking at all these different time frames, and people are saying that this, that, and the other thing, and there's these nanosecond bots, and like, why wouldn't I be looking at like a 30-second and all that? And all of them matter. I mean, all of these have effects on like all of them are right. But when you're looking at returns, when you're looking at then there's going to be larger returns, with more amounts of time, from I mean, just that's just like if there's a 10% move on the 5 second and it lasts, then that will ripple out to the weekly. Then it'll be a 10% up week, if it stays there. But obviously it won't just stay at 10% for if it happened on a second or a 30-second time frame. So going back to that analogy, the microscope analogy that Bali told me about, is that you're looking at different time frames as a scientist would look at a microscope. So or look at like cells with a microscope. So then you're looking at, okay, so basically the monthly is just a much more zoomed out look at price and or returns, whatever you're focusing on, right? So you're zooming out when you're looking at a monthly, and then when you go down to a 4 hour, you're zooming in. So you're just getting a closer look at what's going on a much smaller time frame. But yeah, look back in the Discord. I was able to explain that a little bit better through text, but that microscope analogy really helped me. Is that okay? So for instance, we're looking at the 4 hour here on the Nasdaq, and a big thing that we've been looking at is the DO, right? The DO is really cool indicator. And it takes into account the distribution and well, not only the distribution, but log normal properties and things along those lines. But anyway, so I'm wondering, is this 4 hour gonna bounce? Like do I need to like really like hedge my Nasdaq position? Because if I do, then no pun intended, but then you're going to then like, how do I know that, you know? So then I can look at a smaller time frame. I can zoom in and I can go, okay, what's happening on an hourly? On an hourly, it's losing the DO, it's changing colors, it's getting outside of the standard error range, and that's leading me to say, okay, that the Nasdaq is not a buy right now, and that's taking into account also the weekly expected move there. And okay, so like, is it going to bounce right there? Like is it going to bounce off that standard error on the DO, right? I don't know if that's exactly a standard error. It's I know that sometimes that math's used, but is it going to bounce off that? And then you can see that the 30 minute and it is losing it. And so then I then you see some people and they'd be like, oh yeah, like let me buy that bounce because it worked over. Well, it didn't. Well, there isn't like you don't ever want to look at things like that. Don't ever want to look at things like that. But if you're wondering, oh, should I lower cost basis right there? Well, there's a couple of different things telling you not to lower your cost basis right there. Is that and that's not saying that it can't bounce off of that. But it's just a way to look at things. Is that you've got your expected move, and if I wanted to lower this expected move, I mean that's a 12% probability. So that's not likely to begin with. So then I could go, oh, like maybe I can make it a 25% probability, right? See, price is outside, and returns are outside of the 25% probability. So then you're looking at that and you're saying, okay, then you're looking at that and you're saying, okay, that I wouldn't want to be buying outside of 25% probability for the week, for weekly. I mean, that's so if you're trading, you wouldn't want to be entering into a long position right there. And if you're investing, then you can look at things right here, and this is a monthly right here, and I mean the center line's at 17,130 of the distribution. So I mean, yeah, I mean over time, I mean that would be a good buy, but not right here. I mean right here, right now at this moment. So let me see. Let me go back and make this 12. And that's just kind of the way that I'm looking at things. This isn't like, I mean, scripture, whatever you want to call it. This is just the way that I've learned, and that are effective. No, there's an echo. Fuck. Let me see if I can. Let's see if I can turn that down. Yeah. Maybe. Fuck. Let me know if that echo goes down, but I don't think it's too bad. Cool. But let me know if that echoes way too much, because I don't want to keep going. Yeah. Fuck. Let me see if that helps things, maybe. Maybe it's because I have something up here that I shouldn't have. Yeah, let me just go back. Yeah, sorry about that, guys. I'm definitely gonna get my stuff together with the stream. But yeah, the two being, yeah, that's a new indicator. And let me see if I can change some things just so that we're not going. Maybe I might have to change some things here. Maybe we've gotten back to, maybe it's not as echoey. Yeah, still echoing. Let's see how that works. Yeah. Sorry, guys. All right, let's see. Is that any better? I don't. Maybe. Bali's the guy right there. Should be good, but let's see. Yeah, maybe just. No, don't go away, Bali. I mean, if you want, but whatever. But hopefully. Can you guys still hear me, or is it? It's a bitch. All right, it's gone. Cool. All right, guys. Cool. So, all right, so that's the Nasdaq. So what else do we want to look at? I care the most about the Nasdaq, but we can check out some other tickers for sure. Let's see what's moving the markets right here. Yeah, I think that is the output. There is something going on with that. Yeah, audio, visual, all that stuff. I got my hands full learning the indicators and learning about different option strategies and things like that. But let's see here. So we got ETH down by 7%. So we can check out ETH for sure. And I honestly consider ETH kind of a bigger deal in the crypto space now than Bitcoin, just because of the way that the mining and everything that's going on with it. That it seems like it has a little bit more pull, but I don't know. There's no data behind that. But let's see here. All right, so you had your weekly center line of the distribution over at 44.77, and let's see. Let's go to a monthly. Expected move on the monthly right here. So that's 24 right there. And we are getting down to a 12% probability. There's a 12% probability that this month will close at 36.10. And then we can we can totally check out mutual information on there as well. And we can kind of see how it's related to Bitcoin. And you can see so let's check this out on a weekly 5-day. Yeah. So normalized mutual information against Bitcoin is 0.25. So there really isn't that much mutual information. The correlation's at a 0.8, but that's only, I think that's taking into account just the linear relationships. But I shouldn't really talk about that. But anyway, then we can compare this to total, right? And the total crypto market cap, the mutual information is a 0.4. So by looking at ETH, you can describe the total market cap of all the cryptos just by looking at ETH. So 0.4. So then what we can look at is we can go over to Bitcoin, and we can see how that looks. And that was on a 5-day. So I just want to make it consistent. That was on a 5-day. So 0.5. So you can look at the entire crypto market just by looking at Bitcoin. You can explain 50% of it. As opposed to Ethereum, you can only explain 40% of it. So what I kind of said there in terms of mutual information, that's not as accurate. That's a great point right there. And kind of looking at Bitcoin. So Bitcoin has a 12% chance of closing the month out at 45,000, right? So that's obviously an unlikely area, but just because it's an unlikely area doesn't mean that it's not going to, you know. So then we look at the 5-day due, and you're seeing that the 5-day due is giving you that bearish read right there, or I mean, not even bearish read, but just negative, more skewed towards negative returns, I guess. And you're seeing that, and it's like, okay, that was something that was kind of eye opening to me. And then I saw the 7-day as well, and the 7-day is just starting to turn pink. And the last time it turned pink was over. We had it over in that large dump right there, or decrease in price. Sorry about the technical analysis terms and shit like that. I'm trying to get that out of my mouth. But let's see here, and then you can see how the expected move as well. So these were weekly expected moves, and then you look at it on a daily, right? You look at it on a daily, right? So then these are daily expected moves, and if we go back to those turbulent times, or volatile times, as I should say, then you can see how this is a 0.15% probability. that in May of 2021 that Bitcoin was going to do a weekly close at $38,000, and you see the wick, 29,000. So if you want to get if you want to get froggy and you want to hit a leverage bet right on that blue dot right there, well, just know that there is a there is potential for that to go the opposite way. So even with the probability cones and all that, so just be aware of that. So you really want to be dialed if you're doing stuff like that. Yeah, exactly. Like so like the do is something that we've all been using, just kind of experimentally a little bit, but there's been some really cool results with it, but it's just a way of describing price. It's a way of describing all that. So like all these tools, we're just describing the randomness. Like that's a big part of it. Is that we're they do a damn good job of describing the randomness. But that's all it is. It's not like some type of thing that you're like, oh, like now I have the expected move, and if it gets down to this blue dot, I'm going to YOLO my whole account. Well, just know that it is a random walk price, and that there are potentials for truly fat-tailed events, and I mean that's showing you a fat-tailed event right there, 32,000. But you have to take it into a context. So then what we can do is we can go over and we can go, okay, yeah, like let's talk about some things that are of like macro context for the cycle of Bitcoin, and it's let's go to a quarterly, right? And then we can go to quarterly, go to same as chart. I mean, you don't even have to do that with multi-time frame expected move, but just so that you know, you can go same as chart. And all right, so this is for the past 16 quarters, right? So for the past 16 quarters worth of price data, right, or returns data. Sorry about that. So we have a lot more quarters than just that. So let's take into account 40 quarters. So this is the entire going back to 2010 when Satoshi was spending his Halloween coding Bitcoin, the savage that he is, or he whatever entity it was. But all right, so we can go back. So this is for the past 40 quarters right here, and then we can look at things in the center of the distribution going back is at $39,000, and then there's a 12% chance that this quarter in 22 days closes at 32,000. So then we're taking that into account, and we're saying, okay, so Bitcoin can close over here at 30,000. If I'm long term trying to acquire Bitcoin and keep that as something that I have exposure to, and that can help beat out inflation and things like that, then I'm looking to acquire at 30,000. Hell yeah, I'm not going to YOLO my account, but I'm definitely going to look for some things at 30,000, and then at 20,000, hell yeah, and then at 11,000, yeah, I'll take some, but then you're talking about, yeah, like even at this point right here at the 32,000, you're starting to be there's potential that it's a fat tail. So then you look at this and you say, okay, then maybe I'd want to have it so that it's more of within the bounds of the bulk of quarterly values. And we can look at, okay, so, and then there's also let's see here. Yeah, let's keep this at 32. Yeah, so 32% chance that Bitcoin closes up at 60,000, right? And then there's a 32% chance that Bitcoin closes at 40,000. So that's kind of the context of, okay, that's much more macro context. I mean, there's been 40 quarterly closures on Bitcoin, roughly. So oh yeah. So then we can go over and we can look at things like VRT. So are we following a random walk? And so then what I'll do is I'll throw up this third pane, and make sure that we're on a quarterly. So that's the thing with the interval, is make sure that you're on the time frame that you want to be analyzing. And there's not as much data to be able to populate for that. So then we can go to a monthly, right? And we can use that as a proxy to analyze quarterly returns. And you can see that since March of 2021, the self-similarity of returns has been decreasing. So you want to have a high self-similarity of returns, or you want to be riding the increase. Sorry about saying you want to. I mean, that's a mischaracterization. But ceteris paribus, or all things being equal, you want a high self-similarity of returns, from the way I look at it. So then we look at VRT, right? And all the VRT values are within a random walk, and so we are following a random walk, and the trend is actually decreasing. So you're not gonna see as many outsized returns, and then we can look at it, and we can zoom in on the distribution and zoom in on a weekly. And so we're really deviating from a quarterly analysis here, because even that monthly analysis right there, it's only 33% of the quarterly, right? So we've got relatively low volatility at a 30. This can get it to 100, but it's not that low though. So take that into account on the weekly for Bitcoin. And you have trend. You have trend, but not only trend, but we're getting outside of a random walk. So we're getting outside of a random walk. So that may be advantageous for maybe if you do see Bitcoin get down to that quarterly improbable area of 40,000, then maybe add some to your bag, whatever. But I'm not. This isn't financial advice. None of this is. I'm an amateur. I just. This is a great way for all of us to learn. So we're looking at that on a weekly, and it's like, oh, so it's looking like things. We're getting close to a weekly trend. So let's see how that looks on a 3-day, right? So then 3-day, it's actually giving you an opposing or conflicting signal, or way different than that. But like a 3-day, it's just showing you that while on a weekly it looks like things are about to get outside of a random walk, on a 3-day it's really not getting outside of a random walk. We're coming back into a random walk, and we're actually getting outside of that trending phase, and we can kind of see on this indie right here, we can go, okay, so what looks like outside of a random walk and trending, okay? We can look at that, and you'll be pretty surprised. So what we'll do here is we'll turn this back into 2-pane. I don't know why it did that. Let's see here. We'll go 2 panes. Maybe I have to move this chart. Yeah, I'll move that chart back. Or I'll move that chart back, yeah, one more time. And then you can see right here that we were outside of a random walk. When were we outside of a random walk and things were trending? It was when we had some extreme moves right here to the downside. So when you see that, you can kind of compare it with other points previously, and you can say, wow, that's a real extreme, but it's not as extreme as June of 2014. I think that was one of the biggest percentage moves on Bitcoin ever. And we can go back and we can look at that and we can say, well, if this was crazy and we saw 0.15% moves, then let me see what it looked like in 2014. And I mean, we can go back and yeah, that's pretty nuts right there. We'll look at it though. Yeah, it was this move right here. So I'll turn off the expected move. I'll turn off the do, and then we'll look at why this was outside of the but I think that's because we didn't have as much sample sizes as well. But you see how we're over here, we're over in a random walk, and then we get up to over here, and then there's these outside moves, but I don't know for sure. But anyway, let's get back to 2021. All right, yeah. So Bitcoin doesn't look that good right now. In terms of like just day-to-day action, and I mean, it depends on what type of style you're trading as well. Like, are you trading day-to-day, hour-to-hour, or are you trading month-to-month, quarterly-to-quarterly? Like, I mean, you probably are starting to your ears are perking up when you're looking at a weekly expected move, and prices. There's a 12% chance that price gets to 45,000 and closes there. That's definitely something significant. And looking at things on a monthly, then we can go back and make sure that this is on a monthly. But that's the advantage right there of having all these indicators up, is being able to check different metrics and for different time frames, and seeing how those all come together for whatever hypothesis that you're trying to test. So let me move this back. Cool. And this is the weekly. I'll move that chart back too, just so that we can keep things consistent. All right, cool. Yeah, so that's for Bitcoin. Where things aren't looking at the best right now, but I mean, still doesn't make price any less random. The VRT, then you can look at that and you can say, okay, let's look at this on so. This is a 5-day right here, so then we can look at a 5-day. And you can see that price is not only trending, but or returns are not only trending, but then you also have, then there's also a, it's outside of the random walk. So that's huge right there, is that things are trending and they're outside of a random walk. So I mean, as somebody looking to trade, it depends on how you're trying to trade, but that is an interesting kind of perspective. And all right, yeah. So let's see what else is moving. You can look at some other cryptos too, but the amount of price data that there is and returns data is significantly less, ETH and stuff like that. But VIX, yeah, VIX is up 7%. So let's see, yeah, let's check out ES. S&P 500 futures, and you can see how it was outside of the weekly 12% probability, and now things are coming back into the 88% range. So there's an 88% probability that S&P closes this week between 4,700 about and 4,400. So there's definitely so yeah. Any other indicators that you're looking at for directional biases to support that EM probability hypothesis? Oh yeah. So yeah, definitely volatility. That's definitely one that you can look at right there. So yeah. So I'm saying, oh, then Bitcoin's not looking the best to kind of trade or get into a new position from what we see. So then we can go in and we can stay on Bitcoin. And I look at the MOM for sure, which is taking into account volatility and returns. And the way that I read this is that the XEM is going negative, and that we have negative returns right here. They're at a 0.70. They're bounded roughly about the 1 area. You can see that they get down below 1 a little bit, like over here on the 21st of May, which is a real extreme move, down to 1.1. So yeah, so you have negative return, the mom's signaling negative, and this is on a 5-day, so then we can look at it on a daily. Depends on what type of traders we have, and so within a daily, it's within a random walk, and then we have the mom, and the mom is going negative, and there's the XEM as well. So I mean, I wouldn't want to be looking for any daily scalp longs or anything like that during this period. And then entropy is decreasing. So then you can see on the candles how I have it visually that, okay, so that when these candles are green, that's giving me an indication that entropy is relatively low in comparison to the past 5. And then yeah, so then if I'm trying to form a bias right here, saying, oh, like, but that it all depends. Oh, if I'm trying to form a quarterly bias right here, that we might actually get to that $40,000 12% probability, and then and that would be just more for like a long-term accumulation, not for like a more like a leverage bet or something like that. So that's kind of looking at some things longer term, and then we can look at the market beat. So I've got like 500 tickers right here or 500 symbols. Sorry about that, guys. And then we can look at and we can see, okay, so there's things like LCID, which is an EV company. We've got Backed. So like Onyx was looking at Backed, and and saying, oh, can you look at Backed? And I was like, oh, for sure. I've been looking at this for so long, like since it was a SPAC, that I wanted to get long it, right? So then we go 30 right here, and for the past 30 weeks, this expected move, there was less than a 30% probability that Backed was going to close above, or let me make sure that this is, yep. So 1 week 30, yeah. So that the Backed was going to close outside of 1540. So then looking at that was pretty telling, and then we can look at VARK. Oh, is VARK dot tech. I don't even know if that's a ticker. I'm pretty sure that's like a bot trying to spam or something like that. But anyway, yeah, VRT is hot. And what else do we want to look at? Is anybody? I'm pretty sure Megan Garrison's like some type of bot or something like that, but I don't know. And we can look at like really cool indies like the omega ratio. The omega ratio is a free indicator, and I've been getting into I've been kind of buying up some Hive, and that's really been something that I'm looking at, and it's got a great omega ratio. But still though, that doesn't mean that the prices and stuff like that aren't going to go lower and stuff. But comparing that to other cryptos, our low risk security is ES, right? And then we have this right here, BTC. And this is on a daily right here. So Hive has a better omega ratio than ETH. I mean, we could actually put this on the ES right here. And then you're comparing ETH and Hive, and they have roughly the same omega ratio. But yeah, so anything else that we're looking at? DWACW, the warrants right there getting crushed, about 13% down. We got DWAC itself getting crushed, 13% down. It seems like the warrant should be down by more than the asset. But let's see. I don't know what vark.tech really is. But it seems Daniel Fiction. I don't know what's going on with that, but yeah, I mean, if you want me to look at a ticker for you, I can definitely do that. I don't know if there's the presence of a bot or not, but they're just putting random stuff in that chat. But yeah, so we can look at UVXY, or I mean, yeah, we can just look at the VIX, right? The VIX was pretty cool. So it had a crazy down move. It was down about 40%. And then we can open up. Yeah. So this is basically the implied volatility on the S&P in a sense. Of out of the money options. So when the implied volatility on SPY increases, that means that there is some type of uncertainty that's going on that the market is preparing itself for in one way or another. And there's also another index called the skew index, and that shows another way of showing that. But let's see here. So on the weekly right here, the VIX. So for anybody that was trading the VIX, and the VIX is, I mean, it comes in a variety of different products. So for the past 2 years of weekly candles, that there's a 2.5% chance that the VIX closes this week at $21. So for this weekly candle, and there's a 0.15% chance that the VIX closes at 1670. So that gives you some perspective. But then look at the monthly, right? So the monthly has a whatever percent chance, and the VIX is mutual information. So the VIX is mutual information with a lot of different things is really interesting, because you're looking at the amount of uncertainty that's or the implied volatility of out of the money options for the S&P 500. So when we're looking at that, that's something that's like, okay, when the VIX is high, that means that there's uncertainty in the S&P 500. So then when we compare the mutual information, that the normalized mutual information is 0.07. So when we're comparing it to the entire market of crypto, right, there isn't a lot to really observe by looking at the VIX. But then if you look at the information adjusted correlation, that gives you a little bit more of a tell that's negatively correlated, so that when the VIX is high, when the VIX is increasing in price, that there is a decent chance that the entire crypto market cap is going down. So then we look at it compared to the NAT, or let's start off with ES, right? Or actually, let's do SPX, because I think that the calculation is based off of SPX. But okay, cool. Yeah. So the normalized mutual information. So when you look at the VIX, you can explain 0.26 of the SPX, which it seemed like that would be higher. But then you can look at the adjusted correlation, and that's negative 0.8. So clearly negatively correlated with the SPX, which makes sense when people are buying up out of the money options to hedge their portfolio. And yeah, so you can also also the panel shows you correlation of returns. So returns, yeah. So then anything above 0.5, that's something significant. And looking at that, I mean, compared to the SPX, so that's the information adjusted correlation in regard to returns. So maybe we should be paying more attention to the information adjusted correlation, just because that seems to have a more significant readings more often, because I couldn't find a lot of normalized mutual information, which makes sense, because by looking at the VIX's chart, how can you explain the SPX? And you really can't explain the SPX that well. So then we can put this onto Bitcoin, right? Or let's stay consistent here. So we have it on the VIX, right? And yeah, exactly. It does take a large sample size. So let's see if, but anyway, to be able to because think about what that normalized mutual information is. What we went over yesterday, the last 30 minutes of the stream, it was all about being able to explain be able to explain one variable with another variable, as opposed to the strength of a relationship, which is correlation, and then we're looking at the mutual information, and we can compare it to the dx, right? Dxy. Actually, I'm just gonna go with dollar futures. But I think that right there is DXY anyways. Is that they probably have a future that pegs the dollar versus multiple different currencies. But so the mutual information between the VIX and the DXY is at a 0.04, and the information adjusted correlation is 0.37. So that's telling us that there really isn't, you can't ascertain anything really about the DXY by looking at the VIX, which makes sense. I mean, the DXY is measuring currencies against the dollar, and the VIX is measuring out of the money options and implied volatilities essentially. So when we're looking at anything else, so then we can look at these things compared to SPY, right? Or to ES, right? That this is just the future. I like the future because it has more data, and it has less gaps and things like that. So negative 0.78 information adjusted correlation on the daily for the VIX, and let's check out the 5-day. So sample size of 500. That is interesting. The normalized mutual information is at 0.1. Let me see. What was that on a daily? It was at a 0.23, so twice as much, a little over twice as much. And then the adjusted correlation is negative 0.5. And then the information adjusted beta is negative 4. I don't know much about the information adjusted beta. I haven't looked into a lot about betas. That's definitely something that we'll look into. I mean, I'll definitely put that on the list of things for next stream, no doubt. So I'll definitely check that out. Let me delete this alert. I don't know what I was thinking with that alert. Maybe just because it's getting towards the second standard deviation. Yeah, for sure. So then what we can do is we can go total, right? So this is the total market cap of crypto calculated by TradingView. Watch out. And then so then we can put this on, right? The mutual information, and we can put that onto the VIX, right? So the thought process being that when there's uncertainty in the S&P, then there should be uncertainty in the crypto markets, right? So then you have a 0.06 mutual information of the VIX, and then the information adjusted correlation is negative 0.4. So that's more of negative 0.45. So that's a little bit more leading that okay, yeah, you're thinking, okay, so yeah, exactly. So this isn't, I mean, the VIX doesn't tell you what the whole crypto market cap is doing. But maybe it's more so because, I mean, the total crypto market cap, it's tough to really point down how they're calculating that. But I mean, anyway, we can. Wow, that's cool. Yeah. So beta is just how much a move would reflect in percentage on the other. So that negative 4 reading that we saw, that would be like a negative 4% on a day. I forgot what that was, but we'll go back and look at that in a second. But so then we're looking at the VIX compared to the total crypto market cap, and it doesn't really tell us. It doesn't really tell us that there's going to be a significant move in the total crypto market cap if there's an increase in the VIX or a subsequent decrease. The VIX and the total crypto market cap are there's not a lot of mutual information in between those. So then we can go over and we can look at the DXY. Everybody loves to talk about the DXY, right? And then you can say, okay, so normalized mutual information is 0.07, So comparing that to the VIX is 0.06, so negligible. And then you look at the information adjusted correlation, and it's positive. So when the DXY, so when the US dollar gains strength, the total crypto market cap also gains strength. And it's, I mean, the information adjusted correlation of 0.49, we'd obviously want that closer to 1, but that is definitely telling. And then that beta right there. So going back, okay, yeah. So then that 4.15%. So that means that there would be a 4% move on the DXY, baby. That doesn't seem right. But that would probably be a 4% move on the total crypto market cap, just from the way that currencies move. But maybe I'm not interpreting that right. But let's go to something that we can trade, right? So let's go to Bitcoin, right? And then we look at the DXY, and there's actually positive correlation, information adjusted correlation, and it's at a 0.4. So all these people that are looking at the DXY and they're trying to short Bitcoin, if the DXY goes up, that doesn't make sense, and it doesn't even make sense because it's not even that strong of information adjusted correlation. So then we can go and we can look at we can look at the VIX, right? So then if there's uncertainty in traditional markets, if there's uncertainty in the S&P 500, then what does that mean for Bitcoin? And that's much different. And there actually is a negative correlation. So that when you see the S&P volatility start spiking up, then there's an information adjusted correlation of negative 0.5. So that would be significant. So if I saw the VIX starting to spike, then maybe you maybe want to buy a put on Bitcoin. But that's I mean, you're not going to just do it right off of that. But I mean, that is interesting. And that's, yeah. So comparing it to DXY and all that. But yeah, mutual information is a big help. And I think we've got another. I don't know who Donna Austin is, but that seems like some type of bot or something like that. But yeah, so yeah, we've got some significant moves in the market right here. So Lucid right here, I'm pretty sure they've got some type of lawsuit or something like that. Some type of I mean, seems like they're having some regulatory troubles or something like that. But I mean, then the narrative isn't nearly as important as the move. And returns and things like that, but yeah, I mean, if you're a long-term investor and there's stuff like that going on, then I mean, you can spend the time on that after you do an analysis. But then we look over here, and we can go back. So Lucid, I think it's been a stock for the past year or so. Yeah, since 2021. So what I'd do is I'd probably put an expected move. Sample size of about 30, right? And for the past 30 weeks, so this has been an asset for about 30 weeks. But let's go back for even further, right? So then we can go back over. So this thing was a SPAC, seems like. So 46, right? So I'll make my sample size 46. So that gives us a much better indication that, okay, yeah, so this is about there's 2.5% probability that this week's candle closes at 34. So I mean, if you wanted to do a one day short put spread or something like that, that would be an interesting type of move. But then that's just looking at the probabilities right there. So then we can go and we can look at daily, or we can even look at, let's say, 5-day, right? Let's keep things consistent. There's not enough returns data, but and you can see how the self similarity is starting to drop. But let's look at it on a daily, yeah, and you can see how there's a large amount of variance in between these tests right here. So this is signaling that things are not in a random walk. but you would want to see some of these tests outside of the critical value. So then you'd be like yeah, it's outside of a random walk, and it's at its 2.5% probability. I think the 1 day short put spread is something that you should probably stay away from. But then you can look at HVP too and say, okay, how much more volatile can this thing get? And it's about a 75. So, but you can still see that short term HVP that at 56. The short term HVP is 56, and the long term HVP is at 70. The short term HVP is orange, and the long term HVP is red. And then so the short term HVP can obviously still expand there. So that's a good way to look at things. And so now you can start to see how all of this stuff comes together, and that I'm not just trying to look like I'm not trying to overcomplicate things with having a bunch of different indicators on the chart. I'm trying to cover all the bases for making decisions in the real world. Just because you see these things on the chart and stuff like that, like there's real world implications for your decisions. So don't think that oh yeah, and I don't want to be one of those LARPers or prognosticators, whatever, or charlatans and act like oh yeah, you can be perfect trading and shit like that. That's a fallacy. So looking at that is there's still room to go with Lucid, and making sure that your sample sizes and knowledge base is correct for being able to make actionable decisions. And is there anything else that we can really check out? There's so much more that we can check out. Bitfarm, yeah, that's a mining company. That was BITO, but BITO is a Bitcoin futures ETF. That actually, I think it has natural drag on it. I'm not 100% sure, but BITO, they do some type of futures where the spread where they I think they sell the front month and buy the back month or something like that. I don't or maybe they buy the front month and sell. There's some type of roll that they have to do with BITO, but yeah, look into that. Let's see. So you see that the majority of these symbols are in the negative. They had negative returns today, right? So let's see some things that had positive returns, right? Because thinking about that log normal distribution that we started today with is that you have that zero bound. So that makes sometimes some trades a little bit less desirable. And so what's leading today is the VIX, So that VIX had that crazy improbable move to start the week. It got absolutely crushed, and making sure that the sample size, right? So we can go back, 100 weeks, past 2 years, because there's been some huge moves on the VIX. But it doesn't really even change things about your sample size. You can see that there is a 2.5% chance that the VIX closes this week at 22.14. So if you're scalping, then you're saying like oh, when the VIX is in this improbable area on the weekly, then I'm gonna try to buy some futures. I'm gonna try to buy some VIX futures, and there would be, okay, so my criteria would be, let's see. Let's put this on a 4 hour. Because all right, so we're only caring about from today until tomorrow. So that probability is only valid from today until 5 p.m. On Friday, right? So we're thinking about, because there's 2% chance that, or there still is a 2% chance that the VIX closes here, right? So but just know that the VIX isn't like a regular. The VIX is working on implied volatility, which is a derivative, which is tracking options and things like, which is tracking the volatility on options. So there is more of that normal distribution that we can put things around with the VIX. But anyway, implied volatility has a tendency to contract. So you need to understand the nuances of the product that you're trading and kind of how things go. But anyway, but this is still a good way to look at things. Is you're saying, okay, the VIX has a 2.5% chance of roughly closing at 22, right? And it's 21.59 right now. So then we look at things on a 4 hour, right? So then, and on a 4 hour, you can see VRT, we're getting outside of a random walk. So that's not really the best. That's not like really a point in the favor of longing a VIX future, because we're getting outside of a random walk. But maybe that is, but just thinking about that. So things are trending, right? So things are trending. We're going to see large moves. The similarity of returns is relatively high. It's at a 0.19, but it is decreasing. Well, and that's the beauty of the indicator. The way it was coded is that not only do you have the SSR, but you have the mean of the SSR. So things are about average in terms of similarity on the 4 hour on the VIX. So we can make everything on the 4 hour, right? And thinking about, oh, I'm gonna long this VIX future because the VIX is trading. There's 2.5% chance that by tomorrow the VIX closes here, right? On the weekly. So we're looking at things and saying, okay, yeah. So we're gonna see large returns. Look at HVP. HVP is low. HVR is high, but HVP, that's what I really care about, because this trade I only give a shit about until the third, or this is going to the 13th of December. Oh, because it's Monday. But anyway, closing this week out, right? I only care about it till Friday. That's the basis that I'm putting on there, is that I only care about this till Friday. So realistically, I'm only caring about short-term types of things going on. I'm not caring about longer-term types of things, because this is just a scalp, right? So then you're looking at the center of the distribution for the monthly right there, and the center's right there about 21, right? So we're basically in the midst of the distribution on the monthly, and then on the weekly, we're below the 2.5% probability. So yeah, but let's keep that lens on of formulating like a potential thought process behind a trade on the VIX, right? So then we're looking at entropy, and entropy's at a 0.9. So that means the efficiency of this market is high, really high. So and the amount of randomness, you can use it as a proxy for randomness in a sense, and the amount of randomness is high. So we would want the exact opposite. We want the exact opposite. We want entropy to be low on that. So long the VIX there, that would be kind of a thing that would be like, yeah, that's not worth it, having that. But we can keep looking at some things, but that would kind of lead me to say, okay, I'm probably not going to do that. But let's see. Yeah, like you can go to an hourly, but look at the returns on an hourly. I mean, HVP is redlined right there. HVP is redlined, and you can also see that entropy is really high. HVR is low, but that's a longer term metric, and that, yeah. So HVP is high. So yeah. So that would probably be like, but you see that do right there. That's a good indication. But then you see the MOM 3G right here. And how many times have you seen a 1.11 on the hourly for the VIX? When was the last time? Can you find it? 18th of October. So what happened on the 18th of October? It was probably something that looked like a pump and dump of the VIX. And the VIX is just implied volatility contracts more than expands, because implied volatility is usually overstated. And then when there's extreme moves, it's usually understated. Credit Bali on that one. I mean, just kind of hammering that point home. But yeah, so you can see that when the MOM 3G gets up to that area, it doesn't. There isn't a lot of history of the VIX the MOM 3G staying up there, return staying up there. Not that it can't. I mean, it can stay up there all it wants, but the way that this indicator, I mean, going back months on an hourly. So that trade probably isn't the best move, and entropy would be the big don't do something stupid like that, and just looking at entropy, it's pretty crazy, but you can see right here that entropy is low. You can see right here entropy reduction. So the advantage of having the coloring, right? So you can see entropy drops and entropy increases too. So then you can see, okay, that when entropy decreases, it seems like that you see the VIX increase, and when entropy increases, you see the VIX decrease. But yeah, those types of relationships with the VIX, and not just the VIX, but entropy in particular is pretty cool. Seeing that, but you want to be trading decreasing entropy because you want to have less randomness in the market. So going back to the VRT, which anybody can show, right? Anybody can have on their chart just by going to the indicators tab. Sorry about that. Where did the indicators go? I don't know. But you can do the / command, and then this will bring up your indicators, and then you can type in variance, and that should be one of the first that come up, variance ratio test pig. And then you can use it, and you'd want to be trading when things are outside of a random walk, depending on what you're doing, but that would be a good sign for something to, well, depending on, yeah, there's a lot of other things to look at, but that's just a signal that we're outside of a random walk and that things are mean reverting. So then when things are mean reverting, you're going to see smaller returns, in a sense. But yeah, I think we've been rolling. Does anybody else have any questions? I know there's probably a lot of questions, but is there anything that I can cover or look at or help clarify, or for next time I can spend some time on? Because I start off with the log normal distribution, and I'll probably go to volatility or something along those lines. But VOY.FYI, I think that those are just spams. But anyway, yeah. So feel free to go into the incubator. It's in the description below. Join the incubator. Become an active community member. Let's educate ourselves together, and if there's any questions or anything like that you want me to show on stream, that's just going to be a benefit for all of us.